Financial Survival Network, helping you to survive and thrive in the new economy. Get our complimentary newsletter at financialsurvivalnetwork.com. This is the Financial Survival Network.
These are difficult times. If you want to buy a house, which still has a certain appeal from a tax standpoint, from an ownership standpoint, then you got to know how to negotiate and how to get through the entire process, which is just getting more and more difficult. That's why we've got Karen Simpson Hankins on. You're probably familiar with her. Her book, #1 bestseller on Amazon, called Conquer the Closing. Karen, welcome back to the show.
Hi, Kerry. Thanks for having me. I always love to be here.
Hey, so we made it through January 10th, 2014. That's the date where the new rules for qualified mortgages kicked in, but the landscape is obviously changing for mortgages, isn't it?
Yes, it sure is. It's going to be interesting times out there, and I think that home buyers are going to really need to be prepared before they ever start looking for a home to be ready for a lot of these new changes.
Yeah, and the changes basically, we talked about them last time. Just briefly go through the changes, what we're in store for, what's happening.
Well, I think that the debt-to-income ratios are going to be a lot tighter on a lot of products with a maximum of 43% debt-to-income. There's also going to be a lot more documentation requirements, so I think underwriting is going to be more strict than it even has been, and realtors have known how strict that has been over the last year and a half. But I think that we're going to see more because now there's a new rule called the ability to repay rule, where it puts the burden on the lender to determine the customer's ability to repay. And there's a certain formula that we have to go through to make sure that they can qualify down the road, because there's going to be basically their financial butt is going to be on the line down the road should the consumer decide that this is something that they couldn't afford or comes into financial distress.
Right. So they're going to be much more picky about who they make mortgages to.
Well, yes, and then each individual file is just going to be a lot more documented and a lot more processes that we have to go through. So credit score requirements, I think, are going to tighten up. Down payment requirements are going to get bigger, and there's just a variety of things in the works right now.
Right. And this means more work for the consumer, and it means more work for the mortgage professional as well, right?
Absolutely, because it's going to be our responsibility to make sure that that consumer has the ability to repay. And so we're going to make sure that debt-to-income ratio and that the more, I guess the thing I'm trying to say is that their budgeting process is more critical now than it ever has been before, to make sure that that payment is something that the consumer can really handle.
Right. And how do they judge whether a consumer can actually handle repayment? I know there's debt-to-income ratios, but those ratios don't tell the whole story, do they?
No, and never before, except for maybe in a couple of the government programs, have we looked so much at residual income. And now I believe that residual income, which is money left over after you pay your bills to live on, is going to become a lot bigger issue when we qualify someone, because they know, a lender knows that everyone is going to need emergency money at some point in time. And so emergency money, for whatever reason, is going to be a lot bigger issue, I think, moving forward.
Right. And what's left over? When we're talking about what's left over, how do they calculate that, Karen?
Well, it depends upon the program, but as a general rule, they're going to want to see at least 2 or 3, 4 months worth of principal, interest, taxes, and insurance, or what we call PITI payments, as a reserve. Now, on some of your government loans, it's even more than that. They base it on family size and number of people in the family, and there's an actual formula that they have that determines residual income. But on the conventional loans, at this point, they're just going to be looking for anywhere from 2 to 6 months worth of payments in reserve, depending upon the program and what you're actually applying for.
Right. And what about the concept of the down payment? Is that coming back, like in terms of how much you have to put down on a property?
Well, I know that the mortgage insurance requirements, traditionally, if you have less than a 20% down payment on a conventional loan, mortgage insurance is required. Now, I've seen mortgage insurance premiums continue to climb, both on the conventional loans and on the government loans, because they're considering the lower down payment programs higher risk. And so the programs that first-time home buyers need and people that get in with minimum out-of-pocket cash, they're going to be the most affected, in my opinion, and that's one of the unfortunate consequences of these new rules, is that the people without the money are the ones that are most affected by these changes.
Mm-hmm. So the best way to do this, obviously, is to get prepared, right? And
right.
How do you start preparing yourself for the process, I guess, is the question.
Well, I think that the most important thing is at least 6 months to a year before, and I know that seems like a long time, but I think that people need to get their credit score, pull their credit report, find out what their scores are, find out if there's anything on their credit report that needs to be disputed before they get ready to buy. Figure out a budget. Figure out what they feel that they comfortably can pay each month, because I can guarantee you that the majority of the people out there have no idea how much they spend every single month. And there's been so many times I've had consumers sit across my desk from me, and I'll ask them, well, what do you think you can afford? And they kind of just give me this blank stare and say, well, that's what I thought you were going to tell me. Consumers don't realize that a lender can't tell them what they can afford. They can only tell them what the lender is willing to lend, because we don't know what their spending habits are.
Mm-hmm. So what do you do then? I mean, that's really the question. How do you maximize your odds or your possibility of successfully getting a mortgage?
Well, I'm so glad you asked me that question, because that's what I've been promoting in my book and my companion workbook that goes along with it. It helps people start that pre-approval process on their own by determining what they spend. Sit down for 2 or 3 months and figure out where your money goes. I did that for myself about 3 or 4 months ago, because it's been forever since I looked at it. And we get into these habits of what we spend. And I couldn't believe the amount of money that I was spending each month just on junk. And when I cleaned it up a little bit, it was almost like getting a raise.
Mm-hmm. So it's really a process that we're talking about, and you really need to collect all this data, and then you have to start analyzing it and figuring out what it all means, right?
Absolutely, because I don't think people realize what they spend and where they spend it. So that way they have the ability to know that they can save for emergencies. I mean, seems like the majority of the customers that I've had for the last 37 years, they take every dime they've got to get into a house. And then if something happens to go wrong and they get laid off, or if they have even a particular month that they have extra expenses unexpectedly, or there's a repair that needs to be done on the house, like the heat pump goes out, they don't have any emergency money to cover it, and then out comes the plastic and the debt starts to rise, and then it's kind of just a snowball effect.
Mm-hmm. And so really, what do you do at that point? That's really the question.
Well, I personally think that you just need to be more aware and more prepared and start paying yourself and start saving every single month so that you've got an emergency money there available, cash reserves, residual income for when it's needed. Then you're going to, even if you sit down and analyze your budget for 2 or 3 months, you're going to figure out real quickly how much of a house payment you can afford and still be comfortable. And that's what my ultimate goal is, to make sure that if I put somebody into a home, that they're going to be comfortable.
Mm-hmm. So your best bet really then is to live beneath your means rather than above it. And over time, then you're going to, basically be able to afford what you're doing rather than really, get into trouble.
Well, I'm very passionate about that because I don't believe that there's enough financial literacy education out there for the general public. And so much of the time in our public education system with high school students and even in college, they're going through their education years, they're getting student loans, they're getting into credit card debt in college because the credit card companies hit them the second they get into college. And so when they get out of school and they're ready to be adults and start their financial lives, they just don't have that financial education that they need. Plus, they're kind of set up to fail because they've got all the student loan debt and credit card debt. There's not a lot of money left over to buy a house. And so I'm hoping that I can help change that by getting that awareness out there and having people take back control over their finances and their budgeting so that they are more prepared to buy.
So what are 3 things that you could do today to really up your credit score and really start, getting ready to buy that house that you want and being able to afford it?
I think the 3 biggest things, if we're talking strictly just about credit, is to, number 1, look at how many trade lines you have. And of those trade lines, which is individual credit accounts, of those credit accounts, what are your balances? Are they over 50% of your total credit limit? If you get over 50% of your total credit limit, let's say, for example, your limit is $5,000 and you're at $3,500, you're over 50% of the allowed credit. There's a huge ding to your credit score when you get over those higher limits. And so try to keep your balances below that 50% mark, and that will automatically raise your credit score anywhere from 25 to 55 points.
Mm-hmm. So
the other couple of things.
Yeah. So get below 50% of your aggregate credit
right
there.
If you do have some negative credit too, push that credit back as many months behind you as you can by, even if you have to go get a secured credit card, and a secured credit card is, let's say, where you put down a $500 deposit with a creditor and then you have a $500 credit line, go out and use it and buy, it's not the amount of credit. Let's say you use $50 or so a month and you pay it off every single month and build up more months of review that's new away from the derogatory stuff, and that will help build your score as well.
Mm-hmm. Interesting. Yeah, I've heard about this a lot, and obviously it's been something I've been passionate about as well. And, it's something that you have to know about, because if you don't, then it's going to come back and bite you at some point. So what about a third thing that you can do to really get rid of this?
Well, I do what I call a credit readiness review, which basically is a profile of their credit history. And it examines how much of their credit is in installment debt and revolving debt and derogatory stuff, for a variety of different things. because there's add-ons to pricing for mortgages, and people don't realize that. The lower the credit score, the higher the add-on. So let's say, for example, a 740 credit score is premium pricing, where you get the best interest rate available. If you go down to 720, there's a 0.5% add-on to fee for a lower credit score. When you get down to about 700, it jumps to 1% or even 1.5%, depending upon the product, which could translate literally to thousands and thousands of dollars over the life of a loan due to a 20-point difference in a credit score. So it's incredibly important to go through this review, figure out what your credit score is, and I can help give them ideas as to what they can pay down or a variety of different things so that they can get that credit score higher. Now, I'm only offering that right at the moment in Oregon, just due to a demand issue, but it's been a very popular program, and it's changing people's lives.
That's a great thing. So, obviously, Karen, people are going to want to find out more about you, and they're going to want to contact you. So how do they go to your website? How do they contact you?
Well, my website is KarenSimpsonHankins.com. You can also get there at needmortgageinfo.com if that's easier. And there's links to the radio show, which has a variety of different educational topics as well. My books are there. There's all kinds of free credit information, instructions on how to get a free credit report, and review your scores.
All right. Well,
just packed with a bunch of good consumer information.
All right. Well, obviously, whether you're trying to get a mortgage or not, it's good to have your credit score as high as it can possibly be, something that you want to do. So go there, go to Karen's site. We'll have links in the show notes to this interview on financialsurvivalnetwork.com. Go there, sign up for the newsletter. We've got a great one. It's coming out in the next couple of days. Also, we won't have a lot of shows the rest of this week because I'm going to be at the Liberty Mastermind Symposium in Vegas, libertymastermind.us if you want to attend. We've still got a few seats left, libertymastermind.us. Karen, can't tell you how great it was to have you on the show again because this landscape is really changing rapidly. And if you want to get a house, you know, down here in Florida, they are going like hotcakes, literally. So, you know, especially with a horrid winter that we've had in the Northeast and the rest of the country, that always results in a major increase in people moving to warmer climates. Every time it happens, a bad winter, people move south for better weather. Karen, thanks so much. A pleasure. We'll talk with you again real soon.
Thank you very much. It's always a pleasure.
FSN. It's about what's next.
Hi, it's Kerry Lutz. I recently decided to move my retirement account into physical precious metals to hedge against the coming times. If you want to move an existing retirement account into physical precious metals that you can hold in your hand, tax-free, there's no company that can do it more quickly and efficiently than Regal Assets. It took them just 24 hours to open my new IRA account, and all I had to do was fill out one simple form. The best part is that Regal Assets does all the work for you. They cover the setup and administrative costs for 2013. If you're interested in making the same move I did, call 855-678-6620, 855-678-6620. That's 855-678-6620, or visit them at regalassets.com. You'll be glad you did, and tell them Kerry sent you.
What happens if the collapse never really comes? You need income, and Jason Hartman can help you get it. He's helped thousands of people realize their dreams of financial independence through real estate investing, and now he's got an unbeatable offer for you. He's offering my ebook, Forget Wall Street, Go for the Gold and Silver Too, for free. Just visit jasonhartman.com/Lutz. The first 100 Financial Survival Network listeners will get the book free. Remember, you can't afford to put all your eggs in one basket. Real estate should be part of a balanced investment portfolio along with gold and silver. Just go to jasonhartman.com/Lutz and sign up today. When it comes to real estate investing, Jason Hartman is the only person we trust on the Financial Survival Network. So make your money work as hard as you do by building an income property empire. Real estate is America's proven investment. Go to www.jasonhartman.com/Lutz and get your free ebook today. That's Jason, HARTMAN.com/Lutz. That's Jason, HARTMAN.com/Lutz. Jason knows how to help you retire with a portfolio of income-producing property. Go to jasonhartman.com/Lutz.
The Financial Survival Network, helping you to survive and thrive in the new economy. Get our complimentary newsletter at financialsurvivalnetwork.com. This is the Financial Survival Network.